Hey everyone, welcome back for another deep dive.
Yeah.
Today we're going to be tackling something that I think a lot of you have probably been wondering about,
Oh, yeah.
which is valuing young companies.
Yeah.
You know, startups,
Right.
up-and-coming businesses,
Right.
sometimes even ones that maybe haven't even launched a product yet.
Yeah.
How do you even begin to put a price tag on that potential?
Right.
So that's what we're going to be exploring today.
Yeah.
And we're going to be taking a lot of inspiration and guidance from Aswath Damodaran's book, Investment Valuation.
Fantastic book.
So I'm really excited
Yeah.
to dive into this with you. I think one of the first things that comes to mind is
Yeah.
why traditional valuation
Sure.
methods
Right.
sometimes just don't cut it.
Yeah. Those traditional methods like price to earnings ratios, they're great when you're dealing with established companies with a long track record.
They've got data. You can look at their earnings. You can look at their history. You can sort of extrapolate that forward.
Yeah, you have historical data.
You have consistent earnings. You can do those projections.
But with young
That
companies,
doesn't apply.
it's like they're writing their story as they go.
Exactly.
So where do we even begin? What's the foundation for valuing these companies that don't necessarily have that history or that predictability?
Yeah, and that's where we really have to go back to the core concept of valuation. At the end of the day, the value of any asset,
Okay.
including a young company, is tied to its expected future cash flows.
Okay, so we are still talking about cash flows.
We are still talking about cash flows,
Even though they don't have them.
even though they might not have them yet.
Okay.
The potential to generate those cash flows
That makes sense.
is what drives value.
But how do you measure that potential? I mean, that's the tricky part, right? The future's so uncertain.
Yeah, it is tricky. It is absolutely tricky, and I think that's where Damo Horen talks about these
Yeah.
three main approaches that we can sort of use as a toolbox.
Ooh, a toolbox. I like it. Yeah, a toolbox.
Tools for different situations.
For different situations, because
Yeah.
not every young company is going to be the same.
Right.
So we've got the discounted cash flow, DCF.
Okay. Yeah,
We've got relative valuation, and then we've got this thing called contingent claim valuation.
Okay, so let's start unpacking this toolbox,
Okay.
one tool at a time. So discounted cash flow, this is a pretty common approach, even for established companies.
Yeah.
How does it work in the context of a young company?
Yeah, so DCF, again, it's all about connecting the value of a company today to the cash flows it's expected to generate in the future. Now, we bring those future cash flows back to the present using a discount rate. And that discount rate
Okay.
reflects how risky those cash flows are. So the riskier the investment,
Right.
the higher the discount rate.
You want to be compensated for taking on more risk.
Exactly. So that's where
Yeah.
the higher discount rate comes in.
So it's like if you compare investing in a government bond, which is considered pretty safe, to a brand new tech startup that could be the next big thing or could totally flop.
Exactly.
The discount rate's going to be way higher for the startup because there's so much more uncertainty.
Precisely. There's more uncertainty, there's more risk.
Okay.
So you need a higher discount rate to compensate for that.
All right. That makes sense. Now, what about relative valuation? How does that work?
So relative valuation is all about comparisons.
Okay.
We're looking at how the market values similar, more established companies.
So we're looking for those comparable companies.
We are trying to find those comparable companies, and we're using these things called multiples.
Right. So things like price to earnings, price to book value,
Exactly.
maybe even enterprise value to EBITDA, all these different ratios that help us compare companies on a relative basis.
Precisely.
So if you find a comparable company that's trading at, let's say, 20 times its earnings, and you believe that our young company is on a path to reach similar earnings eventually, you could potentially use that same multiple as a starting point for your valuation.
That's the general idea.
But I imagine it's pretty tough to find truly comparable companies for young businesses. They're often doing something unique, trying to disrupt the market, so it's not always apples to apples.
It's tough. It's really tough to find those perfect,
Yeah.
comparable companies, especially with young companies.
Okay. And then there's this third approach, contingent claim valuation. This one sounds a bit more complex. What's the basic idea behind this?
Yeah, it is a little bit more complex, but it's very insightful.
Okay.
Contingent claim valuation uses option pricing models. The idea here is that the equity in a young company often has these option-like characteristics.
Option-like characteristics.
Yeah.
Can you unpack that a little bit for us? What does that actually mean?
Yeah. So think about it like this.
Yeah.
A startup with a really groundbreaking technology, there's a chance it's going to become the next big thing. Right. But there's also a chance that it might fail completely. The equity holders,
Yeah.
the owners of the company, they have the right, but not the obligation, to profit. if the company succeeds.
So it's like they have a choice. They can participate in the upside if things go well,
Exactly.
but they don't have to keep pouring money into it if it tanks.
That's exactly the option-like characteristic we're talking about.
So it's similar to holding a stock option, where you have the right to buy the stock at a certain price if it goes up, but if it doesn't, you can just let the option expire.
Precisely. And that's where the equity in a young company kind of aligns with that concept.
So we're taking concepts from the world of financial options and applying them to valuing these young, unpredictable companies.
We are.
That's pretty interesting.
Yes. It's fascinating how you can draw those parallels.
Well, let's face it, young companies are inherently difficult to value, right? There's a lot of uncertainty.
Absolutely. They're probably the most difficult types of companies to value.
I mean, they have limited financial history.
Limited data, lots of uncertainty.
Their growth trajectories are unpredictable.
Extremely unpredictable.
They might be burning through cash,
Yeah.
operating at a loss. It's like trying to predict where a lightning bolt's going to strike.
That's a great analogy because you just don't know.
Right. So we really need to acknowledge those challenges. What are some specific hurdles that we need to be mindful of when we're trying to value these fledgling businesses?
Yeah, so as you said, limited financial history, that's a big one. You know, you don't have those years of financial statements to analyze.
Right.
You can't look at those trends. You can't really apply those traditional metrics.
And the future is so uncertain for them.
Unbelievably uncertain.
I mean, they're disrupting industries,
Absolutely.
creating new markets.
Yeah.
And who knows how those markets are going to evolve or how quickly they're going to grow.
Or if they're even going to exist in 5 years.
It's really hard to predict their cash flows.
Yeah, projecting cash flows for young companies, it's...
And on top of that, they're often burning through cash.
Absolutely. They're investing heavily to grow.
Right.
So you're dealing with negative earnings.
And that just throws another wrench into the whole valuation process.
Yeah, negative earnings definitely makes things a lot more challenging.
So a lot of challenges.
Yeah.
But amidst all these challenges, there's one thing that consistently stands out as crucial when you're valuing young companies, and that's growth.
Growth is everything. It's the lifeblood of a young company.
Because their value is so tied to their potential,
Right.
their ability to capture market share,
Absolutely.
to expand, to really kind of like dominate their space in the future.
That future potential is huge.
And growth is that indicator of whether they can achieve that potential.
Yeah, it's a signal to the market.
But high growth,
Yeah.
that demands a lot of reinvestment.
It does.
For
You got to keep investing.
At the very best,
in it.
sit back and rest on your laurels when you're growing that quickly. You've got to plow those earnings back into the business to sustain that momentum.
And that's a delicate balance because you've got to fuel growth, but also make sure you don't run out of cash completely.
Right. You don't want to grow too fast and then suddenly run out of runway. So is there a way to sort of measure or assess that balance between growth and reinvestment?
Yeah, there's a very useful metric that we can look at here called the sales to capital ratio.
Sales to capital ratio.
Sales to capital ratio.
Okay, break that down for me. What is that?
So it helps us understand how much reinvestment is needed to achieve a certain level of revenue growth. Basically, it tells us how efficiently a company is using its capital to generate sales.
So a higher sales to capital ratio means they're generating more revenue.
More bang for your buck.
Yeah, more bang for their buck.
Exactly.
With every dollar they invest.
More efficient use of that capital.
So that's a good sign. That suggests they're being smart with their resources.
Absolutely.
And they're not just burning through cash for the sake of it.
Exactly.
Okay, so we've talked about growth. We've talked about reinvestment.
Yeah.
And I think we need to come back to that other big challenge we mentioned earlier, which is negative earnings.
Negative earnings. The dreaded negative earnings. A lot of young companies are dealing with this.
Yeah, it's a fact of life for many startups.
It's a common theme.
But it can make valuation even more challenging.
Oh, it does.
So how do we approach valuing a company that's not yet profitable?
So negative earnings. They don't always mean disaster.
Right.
We have to understand why they're happening.
Yeah, there's got to be context.
There has to be context. Is it temporary?
Right. Are they investing heavily in R&D,
Yeah.
building a factory,
Exactly.
expanding into new markets?
Maybe they're acquiring another company?
Or are they just fundamentally flawed?
Or is it a fundamental problem with the business model?
Yeah, that's a big distinction.
Huge distinction.
So it's like you're a detective. You're trying to figure out the story behind those negative earnings.
So they've got to dig deeper.
And then I've also heard this term, normalized earnings.
Yeah.
What does that mean in this context?
So normalized earnings, it's basically adjusting the reported earnings
Okay.
to account for those temporary factors.
So we're trying to get a clearer picture of the underlying profitability,
Exactly.
even if it's not reflected in the current numbers.
Yeah, trying to smooth out those bumps
Yeah.
and get a sense of that true earning power.
So it's like looking beyond the surface
Beyond the
and
surface.
trying to understand the true potential of
Absolutely.
the business.
That's a great way to put it.
Okay, so we've talked about discounted cash flow. We've talked about relative valuation. We've touched upon contingent claim valuation.
Yeah.
And I think we need to delve a little deeper into that option-based approach,
Yeah.
because it sounds like there's a lot to unpack there.
There is. It's a really fascinating concept.
So we'll come back to that in the next part of our deep dive.
Sounds great.
Okay, so we're back and ready to unpack this idea of valuing equity in a young company as an option.
All right, let's dive in.
I'm intrigued, but I'll admit I'm a little fuzzy on how we actually apply option pricing models to this.
Well, remember how we talked about the option-like nature of equity in these companies?
Yeah, the right to participate in the upside,
Mhm.
but not the obligation to keep investing if it tanks.
Exactly. Contingent claim valuation basically formalizes that.
So we're not just saying it acts like an option, we're actually using those models to put a value on it.
Exactly. Think of it like this. A financial option, like a call option on a stock, gives you the right but not the obligation to buy that stock at a specific price by a certain date.
Right, if the stock price goes up, you exercise your option and make a profit. If it tanks, you let it expire and your loss is limited.
Now apply that to a young company's equity. The equity holders have a call option on the future success of that business. They have the right but not the obligation to profit if the company's value skyrockets.
So if the company does well, they exercise their option and reap the rewards, but if it flops, they can walk away and limit their losses.
Exactly. And just like with a financial option, the value of the equity depends on things like growth potential, the volatility of expected cash flows, and the time it might take to achieve success.
I can see how this would be especially helpful for companies in like tech or biotech where there's huge upside potential, but also huge risk.
Absolutely. Think of a young biotech company developing a new drug. It could be a blockbuster, but it also might not make it through clinical trials.
So valuing their equity as an option takes into account both the potential for massive success and the very real possibility of failure.
Exactly. It helps investors understand the risk-reward balance more clearly. But of course, option pricing models can seem a bit daunting to some people.
Yeah, I've heard of black skulls and things like that, but they always seemed like, advanced Wall Street math.
They do have that reputation, but the idea behind them is actually fairly straightforward. Like, the Black-Scholes model is essentially about figuring out the fair value of an option based on a few key inputs.
Okay, like what kind of inputs are we talking about?
You need the current value of the underlying asset, the volatility of that asset's price, the time until the option expires, the exercise price, and the risk-free interest rate.
I think I can see how we might adapt those to the world of young company valuation.
Exactly. Let's say we're looking at a young tech company. The underlying asset's value could be estimated by adding up their tangible assets, like equipment, and their intangible assets, like patents or brand value.
Okay, that makes sense. What about the volatility of the asset's price, though? How do you estimate that for a young, unpredictable company?
You could look at the historical volatility of similar companies or consider the general riskiness of the industry. A sector known for rapid change and disruption would naturally have higher volatility.
Because you just don't know who's going to win and who's going to lose.
Exactly. Then you've got the time until the option expires, which could be linked to how long you think it'll take the company to become profitable or maybe reach a milestone like an IPO.
And could we think of the exercise price as the capital already invested in the company?
You got it. And the risk-free interest rate is usually pretty easy to find. Just look at a government bond yield.
So we can plug all these adjusted inputs into a model, and it gives a more nuanced valuation that accounts for those option-like qualities.
That's the idea, especially when traditional models struggle to capture the full picture.
But it's not just about plugging numbers into a formula, right? You still need that gut feeling, that understanding of the company's story.
Absolutely. What are their competitive advantages, their management team, their potential market? Those are all crucial.
It's like being a financial detective.
You've got to connect the quantitative with the qualitative. And remember, we're dealing with possibilities, not certainties.
It's more about building a framework for understanding what could happen.
Exactly. And recognizing that valuing young companies is a dynamic process. New information comes in and you adjust your assessment. It's a constant evolution.
Okay, so stay flexible, be ready to reassess. Any other practical tips for navigating this?
Be aware of your own biases. We all have them, and they can sneak into our analysis.
So take a step back and make sure your preconceived notions aren't clouding your judgment.
Exactly. And don't be afraid to challenge conventional wisdom. Just because a certain multiple is common in an industry doesn't mean it's right for every company.
Each one is unique, and the valuation should reflect that.
Right. It's as much an art as it is a science, blending analysis, business acumen, and creativity.
It's like we're financial artists, painting a picture of the future with limited information.
I love that analogy. But even with the best techniques, there's always that element of gazing into a crystal ball.
Speaking of things that can be hard to predict, we talked about real options earlier. I think we should dig into those a bit more.
Absolutely. Real options can be a big source of value for young companies, but they often get overlooked.
Can you remind us what those are exactly? We talked about financial options, but these seem different.
They are. Real options aren't financial instruments. They're strategic choices companies can make. They represent flexibility and potential upside.
Can you give us some examples?
Sure. Imagine a young company develops a successful tech platform. They might then have the option to expand into new markets or develop new products based on that platform.
So their initial success opens up new possibilities down the line.
Exactly. Or think of a company with a promising new drug. They might have the option to partner with a big pharma company to help with development and commercialization.
So real options are all about having choices and adapting as things unfold.
Precisely. And like financial options, they have value.
But how do you value a strategic choice? That seems pretty intangible.
It can be tricky, but there are techniques like using decision tree analysis.
Oh yeah, I remember that from business school. Mapping out different scenarios and assigning probabilities to each outcome.
Exactly. You can model the different paths a company could take based on its real options, assign probabilities and payoffs, and calculate the expected value of those options.
It's a way to see the potential upside that might not be obvious just from looking at their current situation.
Exactly. You're considering their strategic flexibility.
This is really fascinating stuff. It's like a whole new layer of understanding how to evaluate these companies.
That's what makes this topic so engaging. There's always more to learn, and the tools are constantly evolving.
So if we're thinking about real options, what's the key takeaway for our listeners?
Don't just focus on the current financials. Look for those real options, those strategic choices that could create value in the future.
Great advice. I think we've covered a lot of ground here, and I'm sure our listeners are ready for your final thoughts.
Let's wrap it up.
Okay, so we've explored all these different ways to look at valuing young companies. DCF, relative valuation, options, real options. It's a lot to consider. If I'm an investor, what are some key questions I should be asking myself when I'm looking at a company, especially one with, high growth potential?
Yeah, you hit it right there. High growth potential. That's the exciting part, but you got to dig deeper. The first question should always be what's driving that growth? Is it sustainable? Or is it just a flash in the pan?
Right, because a company can grow really fast for all the wrong reasons.
Yeah.
Like maybe they're underpricing their product just to gain market share.
Yeah, unsustainable pricing.
Or they're burning through cash on marketing.
Crazy marketing spend
Yeah.
that they can't keep up.
Or even, sometimes there can be some creative accounting going on.
Oh, yeah.
Yeah.
Got to watch out for that.
Right.
You want real sustainable growth.
So how do you tell the difference? What does sustainable growth actually look like?
Well, it usually comes from having a product or service that's truly different, something that solves a real problem. And they need to be tapping into a market that's big and growing.
Right, so there's actually room to expand.
And they got to have a solid plan for scaling up without, breaking the bank.
So it's not just about how fast they're growing, it's how they're growing.
Exactly. Quality over quantity. Right. And another big question is, how much money are they going to need to keep this growth going? Young companies, especially the disruptors, they can be real cash hogs.
Yeah, they need to invest in R&D, marketing, hiring, all of that.
All of it. And if they're constantly raising money, that can dilute the value for existing shareholders.
Or they end up with a ton of debt.
Yeah, debt can be a killer if it's not managed well.
So you're saying investors need to pay attention to capital efficiency, right?
Yeah.
Like how much revenue are they generating for every dollar they invest?
Exactly. And their burn rate, how fast are they going through their cash?
Yeah, that makes sense. And I guess the other big question is, what's their path to actually making money? Even if they're not profitable today, do they have a realistic plan for getting there?
Absolutely. At some point, growth has to turn into profit. Investors are patient, but not infinitely patient. You got to see that light at the end of the tunnel.
So do they have a timeline for breaking even? What needs to happen for them to get there?
Those are the questions to ask. And this is where those valuation techniques we talked about can really come into play. Like DCF can help project those future cash flows, even though there's a lot of uncertainty.
But we have to be careful with DCF, right? Not get too carried away with optimistic assumptions.
Oh, yeah, got to be realistic. That's where relative valuation can be helpful, seeing how the market values similar companies.
Provides a bit of a reality check.
Exactly. And then you've got the option-based approach, which can be especially useful for those high-risk, high-reward companies.
Right, because it accounts for both the potential for huge success and possibility of, well, things not working out.
It's about acknowledging that range of outcomes.
So it sounds like there's no one right way to value these companies. It's about using a bunch of different tools, being flexible, and being comfortable with a little bit of ambiguity.
That's the name of the game. It's a process, not a precise formula.
And sometimes I think it's important to step back from the numbers and remember the human element. Behind every young company, there's a team of people with passion, with ideas, with a vision for the future.
Oh, absolutely. It's easy to get lost in spreadsheets, but it's the people who ultimately make or break a company.
So we're not just evaluating financials. We're evaluating leadership, culture, the drive and resilience of the team.
You got it. Investing in a young company is about believing in something, not just buying a stock.
It's about being part of a story, even though that story might have some unexpected twists and turns along the way.
And that's what makes it exciting.
Right, absolutely. So as we wrap up this deep dive into the world of valuing young companies, what's one final thought you want to leave our listeners with?
Don't be afraid of the challenge. It might seem daunting, but valuing young companies is like a really rewarding intellectual puzzle. It makes you think critically, question assumptions, and appreciate the power of human ingenuity.
It's about recognizing that the future isn't predetermined. It's being created right now by the choices and the hard work of entrepreneurs all over the world.
And by learning how to value those efforts, we can be a part of shaping that future.
That's a great point. So to all our listeners out there, keep learning, keep questioning, and keep your eyes open for those hidden gems, those young companies that could change the world. Thanks for joining us on this deep dive, and we'll catch you next time.